This is a lesson that I do with my students during kind of the banking session and part of the Federal Reserve System. And I've found, more and more that students need more and more kind of hands-on activities. So after I've kind of given them a basis for, what required reserves are, what excess reserves are, what the Federal Reserve is, then I have the students sort of create this little diagram at their table. Now you could, I just use butcher paper. I give each group of students some butcher paper. I put this up in the front of my room, and then I have the students sort of recreate this model at their desk. And then what this allows us to do is to kind of do a review of banking and to talk a little bit about the Fed, specifically one of the Fed's tools, required reserves, the reserve requirement. Okay, so basically what we do is you can talk to students about, somebody comes into the bank and makes a deposit, and what's going to happen to that deposit. And so we've already talked to the students about, well, there's two things that can happen to this deposit. One is some of the money has to go into excess reserves, some goes into required reserves. Okay? And so then can review with the students that it's the Federal Reserve that controls this percentage here, the amount of a deposit that has to be kept in the bank's vault. So let's just set a 10% reserve requirement here. So let's say that the Fed has set a 10% reserve requirement. Then I ask the kids to then, show me what happens to this $1,000 investment. So, of course, out of that $1,000, $100 will end up in required reserves, and then the other $900 will end up in excess. Okay. Then you can kind of drive home the idea that what the Fed is the Fed is the bank of banks. And so if I had a $1,000 deposit in this local bank B, these two local banks have the same reserve requirements. So we would have $100 in reserve here and $900 in excess here. Okay. And then you can ask the students, okay, well, banks are just like we are. They're looking for a safe place to keep their money. Well, where would be a safe place to store your money, your excess money? And, well, they come to the conclusion that, wow, the Fed's probably even safer than the bank's own vaults. So you know that the banks do store their excess reserves on account at the Fed. Okay? Now, what two things can, in essence, can banks do with these excess reserves? Well, this money can be either loaned out to businesses and households, or the banks can use some of their excess reserve and invest in government securities. Okay, so those are sort of the two options for the excess. Okay? And then we can talk about if the economy is in a recession, then in essence that means there's not enough money in circulation. So, what could the Fed do to make more money available to loan out to businesses? And at this point we can just talk about one of the tools, the required reserves. If the bank cuts back on its required reserves, more money will end up in the excess, and then more money will be available to loan out to businesses and households. And if those businesses do choose to come and get those loans, then that will help increase both investment and consumption spending. Okay. Also, what this is helpful in showing is that, and you can emphasize with kids here, is that really all the Fed can do is do things to help increase the excess reserves. One of the weaknesses of monetary policy is that the banks can increase these excess reserves, or the Fed can increase these excess reserves as as much as possible, but if businesses and households don't come and borrow this money, then this money never does get into circulation, so that's one of the weaknesses. So again, this is, I think, sort of a cheap way of giving students a chance to sort of do monetary policy hands-on as opposed to listening to it through lecture. You can have the students maybe possibly be doing other activities. You may have a couple of tables of students doing this so that you can walk back and forth and work with them. And there are a lot of publications available from the Federal Reserve that you could possibly be having your other students reading while you're working with these two groups.